Everybody. We're live, and good morning to you and all our audience. Good morning to you, Stephanie, and how are you doing? Hello, good morning,
Good
Stephanie. How are
morning,
you doing?
Muyumba. I'm fine. I'm
Yes,
fine,
and
Muyumba.
welcome.
How are you?
I'm fine, thank you. It is Wealth Wednesday, and welcome to everybody who's with us. And for the purpose of taking the journey along, thank you to everyone who's joining us on air, online, Facebook, Twitter, LinkedIn, and YouTube. Thank you to everybody, and we wishing you a wonderful and blessed morning. Let's get down to the order of the business today on Wealth Wednesday. Today we'll be touching on some of the things that have been going on in the market. Yesterday we did see the close of the 3rd of October. We did see that the Kwacha did close a little bit weaker. Again, we're continuing to see a market slump in terms of where we are, 0.46% downwards. Dollars up 1.89% on the week, down up 3.39% year to date on the month, and up 17.18% year to date. Dollar still in a buying pattern, though we are still seeing a slight downward directionality. The dollar is still in a strong buying pattern. Yesterday, we did see the all-share index trade upward by 0.11%, thanks to Zanaco shares going up as well. We did see that the seven-day bond index up 1.16%. 30-day, the bond index up 1.16% on the week. Up 7.43% on the month and 27.49% year to date. We did see also that bond index in terms of the bond index was up 0.11% as well, with USD bond index down 0.35% due to the loss of the FX rate and also the interest rates rising up a little bit. So it's odd that we're seeing interest rates rising on the secondary market and dropping on the primary market. We'll be going through the primary auction data from today. Other news that we did see, other markets that we did see the Rand drop by about 0.36%, up 2.77% year to date, and really upwards on the week, on the month, and year to date, but down on the day by 0.36%, while the dollar was up 0.46%. We are seeing a little bit of momentum building up in the Rand, which is an inflation risk, but it seems to be caught in a sideways band of 1.05 and 1.10. That seems to be the band that the Rand is caught within. We did see the bond index, as we said, move up by 0.11%, up 21.46% year to date. In dollars, up 4.43% year to date, and interest rates are still up 0.84%. So we are seeing still an upwards movement in interest rates on the secondary market. It might look like we're hitting a point of convergence on the secondary market and on the primary market. Let's see how that plays out. Secondary, what other parts that we are seeing also was the wealth industry, the wealth insurance industry. Bitcoin as an asset went down in Kwacha by 1.3%, still up 92.94% year to date. While Ethereum was basically unchanged yesterday, moved up by 61.69% year to date, and gold is up 18.04% year to date, up by 0.23%, mainly due to the strengthening of the dollar. Broad asset markets, this is how we're looking. We did see that bonds are up 21.5%, up 11.3% in real terms. Stocks are up 27.5%, up 17.3% in real terms. USD is up 17.2%, up 7% in real terms. Gold up 18% and up 7.9% in real terms. And Bitcoin up 92.9% and up 82.8% in real terms. Ethereum up 61.7%, up 51.5% in real terms. This is what we're looking at year to date. But if we're looking at the quarter, we have started a brand new quarter. Last quarter, remember, these were the movements. Bonds were up 7%, stocks 13%, USD up 19%, gold up 15.6%, Bitcoin 5.5%, and Ethereum up 3.9%. But if you're looking at it in terms of where we're starting off, Bitcoin is up 2.4% so far in the first few days of this quarter, while you're seeing USD up 0.8%, gold down 0.5%, Ethereum up 0.1%, stocks up 0.4%, and bonds up 0.1%. And this is where we have the kickoff point when it comes to the quarter-to-date activity. Now let's switch into the bond auction. And as much as we were watching a budget speech, as I said, which we will go in depth on Friday, we do have a bond auction that also happened on Friday, the September bond auction. Multiple things of interest did happen. First thing we'll point out in the bond auction was that interest rates went down across multiple tenors. We saw everything. We saw the seven-year interest rate moved. The 2-year interest rate moved down by 0.2%. The 3-year interest rate moved down by 0.5%. The 5-year interest rate moved down by 1%, and you saw the 5-year, the 5-year interest rate moved down by 1%. You saw a 0.8% movement down of the 7-year. The 10-year also moved down by 0.75%. The 15-year moved down by 0.75%. So generally, we saw bonds reflecting a 2.13% movement downwards in terms of the composite bond index or the composite yield. So this is actually quite interesting, seeing bond interest rates starting to move downwards at a time when inflation is moving upwards. Quite an interesting thing. But obviously, growth expectations also might be kicking upwards, though there's still the expectation, though the Ministry of Finance is still holding the line that growth is only set for about 2.7% for the year, though I think that's them managing expectations. In terms of actually what we saw, and this was the really important part, we saw a fully subscribed auction of 100% versus target. But we really saw a lot of strong performance in the 3-year bond index, in the 3-year, which was up 130% from the previous month. We also saw the 7-year up 193%. The 10-year did shift downwards a little bit, and the 15-year did shift downwards a little bit. But we saw strong sales in the short end of the curve, 2, 3, 5, and 7. There was very strong sales that actually came in terms of performance. You did see that there was a strong performance in the short end, 2, 3, and 5, mainly also due to high inflation. Remember, when you got high risk situations like inflation, you do tend to see 2, 3, 5%, 2, 3, 5 year doing well as well, but it doesn't mean there was any sluggish performance in the other ones. 10-year was oversubscribed, 15-year was oversubscribed. It was really the 7-year that was the worst performing, but it had an 80% subscription rate. Other things that we did see in the bond auction, yes, as well, in terms of the spread, this was a much wider spread auction. You could see that about 51%, in terms of beating sales target, about 51% of the sales auction came from the short end and 49% came from the long end. This is actually the standard. This is actually directly to target. You saw sales performance in the short end up by 98% and sales performance in the long end up at 102% down from where it was. So you could see that there was a strong performance leading towards shortening of bonds in terms of the auction. Now, if you're looking at year-to-date data, in terms of where we stand so far, that we've raised about the country's raised about 15.67 billion kwacha in terms of government bonds this year. You have seen the strongest performance coming from the long end. This year, we've actually seen a lot more long-term bonds coming in year to date. 55% of the total auctions have come in from the long term, while you've seen in terms of versus performance, the longer term bonds 7, 10, and 15 have performed 77%, mainly due to the 10-year bond, which has had 115% versus its year-to-date performance. The rest of them have truly underperformed. 15-year bond at 69%, 3-year bond at 68%, 2-year bond at 71%. And you can see that the 5-year and the 7-year have really been the least in terms of the full performance. And this is the battle between the offshore investors. Remember that at the beginning of the year, one of the biggest factors that was pushing the bond market was NAPSA basically pulling a lot out of auctions, mainly because of the partial withdrawal. So NAPSA had to fund their partial withdrawals, but you've seen quite 1/3 of the bonds raised this year have come from the 10-year, with the second highest one being the 5-year, and then you've got the 3-year and the 15-year, which have come in right after that. So this is where we stand in terms of bonds. Now, this is what we saw yesterday. 1.22 billion of the total bond auction came from 10-year. That was the previous one. Now, looking at this one, the highest performer was the 5-year. 651 million came from the 5-year bond, while you're also looking at the next one was the 10-year bond, which dropped in about 589 million kwacha, 410 million from the 15-year bond, 393 million from the 3-year bond, 276 from the 2-year, and 281 from the 7-year. That was the ranking of how much. And you can see all of them except the 10-year and the 15-year all showed improvement, massive improvement from the previous auction in terms of the total sales. Auction performance also showed, you could also see that auction performance was strong across the board, as we pointed out, but versus the previous auction, obviously the 10-year in the last auction was 2 times subscribed, was 2 times purchased, not even subscribed, 2 times purchased, while the 15-year bond was almost also 2 times purchased. But you could see that now you can see the strong performance rates came in the shorter side of it, especially the 2, 3, and 5-year, which all boosted us close to 100%. Now, one of the things we track also is what we call bid rejection rates. What percentage of bids were rejected in terms of the kwacha value? Now, if you take a look at September versus August, September being the dark red line and August being the light red line, You can see that this time 43% of bids that came through were rejected for being too high interest. And also this is what allowed for the interest rates to get pushed down. So if you want to see what pushes interest rates down, it's a lot of demand in the bond markets. Now, what pushed a lot of demand into the bond markets this time is, one, you've got a lot of pension funds who are now starting who are about to get into the reporting season. We have to make sure that their portfolios are clean for reporting season. So this is where they do make a lot of their investments before they get analyzed. That's one. You also have the return of NAPSA, who seems to be replenishing its bond supply or its bond inventory after it's been paying out a lot of those partial withdrawals. Banks probably are still also playing a role, and international investors are still playing towards the long end of the curve. Remember, after the June reading, Fitch, you did actually get Fitch and others starting to put back a grade on Zambia's local currency bonds. So did understand that Zambia did get a slight upgrade. So that's what allowed a lot more. And we've been seeing this performance strong. So what's been pushing this is a lot of demand for government bonds has started to come in. At the same time, we're also seeing demand for the stock market. So asset markets are starting to perform pretty well before the economy has even full-fledged a recovery. So if you're looking at auction performance historically, you can see, again, we've had a fully subscribed auction, but a bit less than the previous one. You could see that we were down from 99% was the previous one, 100% this one, 155 was the one in July. So this was after the announcement. So if you can see from July onwards, this was following the announcement of the creditors deal. You can see that there has been a shot into the arm of the bond market, but the short end are the ones which have now truly started to show some sort of recovery, while the long end has been sustained with a lot of performance. So this is the percentage of sales versus what the target raising was. So this is positive signs in terms of the purchase of assets. Now, in terms of the rejection rates, you can see that rejection rates have also spiked, meaning that this is a sign that also presses interest rates towards the downwards. This is why I've kept saying to people, pile in on your bonds now while the interest rates are still high, because there does seem to be some pressure that's starting to creep in to push them downwards. However, whether this is sustainable is a different story, because we're currently seeing inflation on the uptick as well. So whether we'll see this continuing, that's another story. But on the short end, in terms of the short end bonds, this is now when we're starting to see short end bonds starting to feel some strong rejection rates, though it was a 3-year one that held it the last time. So you can also see this is also happening. Now, in terms of the composite yield, you can see it pushed downwards due to performance in the short end of the curve. It really was the long end of the curve that was actually pushing interest rates upwards in terms of the composite fashion. But now you're starting to see short end performance, and that's also driving interest rates a little bit downwards. That's why we're down to 23.8. And in terms of the composite tenor, we're now sitting around 7.31% average tenor. This is because now we started to see some short end bond performance, and that is pretty much how the bond market fared in the last auction. Mainly what we are seeing is that we're still seeing relatively elevated interest rates in government bonds, but what that is also signaling is the high rejection rates are starting to signal that the market is starting to see some sort of extra demand. 2 consecutive highly rejected auctions, while you're also seeing interest rates now starting to press the needle downwards, especially the short end ones. Whether it's sustainable, like I said, due to inflation rates, that's a different story. So that's the main news that we saw in terms of bond auctions. That was the main report that we picked up. This week, we are now moving back into the conversation we'll be having about understanding risk. Stephanie, I don't know if you recall, we did start a conversation about understanding risk. And to everybody, I wanted to ask if you managed to take your risk, if you managed to start looking at your personality. But just as a review, remember Warren Buffett's rule number 1, never lose money. Rule number 2, never forget rule number 1. So how do we avoid losing money? Remember that the 3 biggest wealth thieves are consuming all your money because you never actually use it. So you never actually invest it, conserving it in places which do not outgrow inflation, and being careless with it and losing it. We talked about what is risk. We talked about risk-free assets and what those are. We talked about knowing your risk tolerance and which category of risk you fall into, whether you're very conservative, moderately conservative, moderately aggressive, or very aggressive. Stephanie, I don't know if you managed to start looking at where you fall in the spectrum of risk. Don't know if we still have it there, but anyway. We did also look at types of risk in terms of systemic versus idiosyncratic. We looked at the various types of risk, which is business, operational, legal, credit, country, foreign exchange, interest, political, counterparty, and liquidity risk. We talked about risk reward last week. We talked about the risk reward ratio and how people can actually start to assess risk versus reward and the importance of it. Now, today, I want to talk to you about the Bridgewater approach when it comes to risk reward. We talked about black swans as well. And I want to talk to you about the Bridgewater approach of diversification and how to look at asset diversification in a holistic and long-term fashion. So we call this passive diversification. That is what the Bridgewater approach is. We call it the Bridgewater all-weather approach. If you're actually enjoying this conversation on trying to figure out how to assess investment risk, please give us a comment give us a comment below, give us a call in, or even just tag one of your friends. Give us a like button, smash that like button if you actually are enjoying what you are hearing today. So today I'm going to take you to the famous Bridgewater approach. Now, historically, what the Bridgewater approach signals is the all-weather Bridgewater approach was sorry about that. The all-weather Bridgewater approach was invented by famous investment investor and founder of Bridgewater Associates, Ray Dalio, back in 1996. And the goal was an asset allocation that did not rely on predicting the future. What Ray Dalio said is, let's rather be prepared for all types of future, and rather than trying to just predict the future. And nonetheless, it was able to balance out different conditions. So I'm going to give you a simple analogy at the end that will help you understand it. The trick in investing is to figure out the proportion of stocks, bonds, commodities, and any other alternative assets you want to hold in a static portfolio. So in other words, you don't want to have to keep selecting too much. You just want to rebalance once in a while. And to hold a portfolio that could reasonably do well for 20 years, and you can occasionally rebalance it, that can predict. So if one cannot predict what form of growth and inflation will prevail. So if you cannot predict with the future with a certainty, you don't know which particular economic condition, then it seems reasonable just to hold a mix of assets. And I want you to think about it this way. If you cannot predict the weather tomorrow, or at least for the next 90 days, or at least for the next year, then would you run the risk of buying clothing every single day to try and match your weather prediction? Okay, Stephanie, I don't know if you're there right now. Right. Okay. Let's get into the second part of the Bridgewater approach to asset diversification for risk management. And the second part, obviously, the origins, as we said, it was started by Ray Dalio. Now, remember, the big idea is that all assets have variable biases. So think about it this way. A shirt is good to be worn in certain conditions. A jacket is good to be worn in certain conditions. Shorts are good to be worn in certain conditions. Trousers are good to be worn in certain conditions. Similarly, assets are the same. Stocks, different types of stocks, growth stocks, dividend stocks, defensive stocks, aggressive stocks, big cap stocks, all these kind of things. Different stocks, different bonds. I've always told people short-end bonds are good for when there's inflation, when there's slow inflation. Long-end, if you're doing a long-term investment horizon and things are stable, long-end bonds work. Offshore investors tend to prefer long-end bonds because of the dollar, because they're investing in dollars and not in kwacha, and that's a different story. So all asset classes and even sub-assets have got environmental biases. They do well in certain conditions and poorly in other conditions. For example, equities and risk-weighted assets are vulnerable to economic contractions, however, nominal government bonds or long-term ones do excellent in contractions and slowdowns. Okay, so when viewed in terms of the risk per unit, so remember what I've always said, risk is the cost of investing. Okay, in this world there will be troubles. That's what our Lord and Savior said. So the cost of doing any progress or growing in any way is risk. So risk per unit, all assets or more are more or less the same. So in other words, the stock market can give you 20% return a year, much more than bonds. But what you'll find is that there's more risk. So it costs more in terms of risk. So really, bonds and stocks are really the same when you measure risk versus return. Investing in bonds when risk adjusted to stocks when risk adjusted to stock like risks did not require the investor to sacrifice more return or to service diversification. This made sense. So investors should basically be compensated for the proportion of risk they are taking. The more risk, the higher the reward. So this is what the Bridgewater approach also understood. They realized that the greater the return on investment or the greater the percentage growth you're going after, the more risk you're more likely to be taking. So really, these things are actually the same. The second condition that you saw in the all-weather approach, the two conditions that they factored in was growth and inflation. These are the defining factors. The best performing portfolios balance inflation surprises, but also common sense says that they also must be balanced for growth. So they looked at historic data and they looked at common sense, and they said growth and inflation are the two key factors that affect the performance of your assets. The value of any investment is primarily determined by the volume of economic activity and its pricing. So therefore, inflation affects it, and surprise impact due to economic changes to those factors can affect the value of your portfolio. So the two directions on growth and inflation equal 4 potential economic outcomes: rising growth plus rising inflation, declining growth plus declining inflation, declining growth, rising inflation, rising growth, declining inflation. Those are 4 economic conditions. And I want you to think about it this way. Imagine you open your door at the beginning of the day, okay? Or you open your window and it's outside and you see it's raining and it's cold, or it's raining and it's hot. Those are 2 different types of clothing that you'd put on. Or it's not raining and it's hot, or it's not raining and it's cold. Those are 2 different conditions again. So there are 4 different things that you think about every single morning when you leave your house. Number 1, is it raining or not? Number 2, is it hot or cold? These are 2 factors that you want to try and see. Is it raining or not? Is it hot or cold? I want you to think about rain like you think about as economic growth. So in other words, raining or not, is the economy growing or is the economy not growing? That's raining or not. Is it hot or cold? Is inflation rising? Is it hot? Is inflation declining? Is it cold? And if you think about it that way, then selecting assets is a lot like selecting clothes. And you realize something very quickly. You don't buy clothes based on what the weather is going to be tomorrow. You buy clothes knowing the weather can be anything tomorrow. So your closet is packed full of different kinds of weather. You just utilize the one for that day. And so too must the portfolio be the same, something that is broadly diversified with and balanced for risk. So this is what we mean when we look at the four different conditions. In terms of that, they're called stagflation, inflationary expansion, Goldilocks, and recession. And if you've seen any of my reports, you've seen me say the economy is still in a state of stagflation, or it's in a state of inflationary expansion. So these are the assets that are probably going to do better. In inflationary expansion, defensive stocks that are based on utilities, natural resources, and essentials tend to do well. Speculative land, property, they tend to do well. Agricultural commodities or stocks that are based on agricultural commodities like your Zafico, your Zambia sugar, your Zambi, these agricultural commodity or biological asset stocks, they tend to do well. Emerging market credit tends to do well. Rising GDP and rising and declining inflation, which is what we call Goldilocks expansion. The equities market as a whole does well. Corporate bonds do well, do that sign. High yield debt, peer-to-peer lending platforms tend to be a bit more attractive, though still risky, a bit more attractive. Village banking also seems to be a bit more attractive during that period. Declining GDP and declining inflation, you find that your long-term bonds, 7, 10, 15 year, they tend to do well. Cash does well. Short-term bank deposits do well. Rental property does well during that period. Declining GDP and rising inflation, low-cost rental property during that does well. Declining GDP and rising inflation, which is what we call stagflation. Intermediate bonds do well. 364-day treasury bill, 2-year, 3-year, 5-year bonds do well. Gold, USD, and also mainstream wealth insurance assets like cryptocurrency and Bitcoin and Ethereum tend to do well during such periods. As you've noticed, Bitcoin and Ethereum have outperformed. At the beginning, that was due to stagflation. So stagflation also helps support certain types of assets. So that's what you want to pay attention to. So the mechanics of the Bridgewater approach is that there are many economic surprises after Bridgewater started running all of this, and they were different from the surprises they preceded the strategy. And the framework is still built to work because it encapsulates different things. The same way, if you open your clothing closet, there's a jacket, there's a shirt, there's a vest, there are shorts. All that stuff is already there. You're just prepared for what weather could be there. And due to the mechanics of a capitalist system, all asset classes will have a pop. And the same way weather condition works. Okay, so that's something I just wanted to put in everyone's mind. And I've given you this clothing analogy, so I really want you to think about building an asset portfolio the same way you build a wardrobe. Okay, you think about the different types of weather and also what's the most prevalent weather in your country. So if you are living in a country which is 9 months cold, then you are probably going to have more cold clothing. If you're living in a country that's 9 months hot, you're probably going to have more hot clothing. If you're living in a country like America, where there's usually rising GDP but declining inflation, you're probably going to have more equities in a portfolio. If you're living in a country like Zambia, where it's hotter, in other words, inflation tends to be higher and growth tends to be tame, you're probably going to have more bonds in your portfolio. So a closet also dictates what is the seasonal factors. Yes, the hot and cold, dry and wet variations of day to day will be there, but also which are the more prevalent conditions. In Zambia, we have got more prevalent inflation in our system, so therefore inflation-proofed assets tend to make up more of a portfolio, but you still also need some of the other ones for when economic conditions are good. So the simple conclusion is what Ray Dalio is saying is stop trying to predict the weather, understand the conditions of where you are in, and just hold a static portfolio and build a portfolio in a static format such that if you just left it for 20 years or 30 years, it would still perform because the ups and downs over a period of time would still let this work. So accept the fact that you don't know what the future holds, so you choose to balance your assets the same way you don't know what tomorrow's weather is, so you choose to balance all your types of assets over the period of time. That's a way that you can assess and manage your risk in a much better fashion. Next week, I'm going to be taking you through risk classifications of different asset classes and also the different kinds of portfolios I would advise a person to be holding in Zambia. You really want to take a look at that one based on your risk preference. If this did not confuse you and you actually managed, if there's anything I want you to take from this is treat your portfolio the same way you treat your wardrobe or your closet. Okay, treat it the same way and think about the way you stock your closet. What are the decisions you are making besides style and brand? What are the decisions of the functional types of clothing you're making? Then I want you to think about building a stock portfolio the exact same way using the two weather conditions that you think about. Hopefully that will help you build an understanding of how to build an asset portfolio and manage risk in a much more effective and simplified fashion. With that, I'd like to thank everyone who has showed up today. Please do also, as I said, if you like what you heard today, smash the like button, give us a comment on what you thought. What were your key takeaways on all of this? To my co-host Stephanie, I don't know if you have returned to us. If not, wishing you all a wonderful day. See you tomorrow. We'll be talking about product market fit one more time in the business ladder tomorrow for our entrepreneurs. Tune in for Enterprise Thursday.